In this video, we'll delve into understanding how to calculate interest on a loan to a family member, even if you don't intend to charge it, balancing financial fairness with maintaining family bonds. To begin with, understanding the basics of how interest is calculated is crucial. The common method used is the simple compound interest formula, which considers the principal, interest rate, and the period. This calculation is helpful even if you plan on not charging interest. The simple compound interest formula is future value equals principal times 1 plus interest rate raised to the power of the number of years. For instance, if you loaned $500 at a 4% interest rate over 9 years, the future value would be $717.44, with $217.44 being the interest. It's vital to note that market interest rates vary, and calculating interest fairly should consider factors like inflation. Instead of cash interest, alternatives like gifts or dinners can maintain the spirit of the gesture without formal monetary transactions. This approach can help strengthen family bonds. However, open communication and mutual agreement are essential to ensure both parties are comfortable. What is a simple formula to calculate the future value with interest? Here are the options. Future value equals principal times 1 plus interest rate raised to the power of the number of years. Interest rate equals principal divided by number of years. Principal equals future value minus interest. And future value equals principal times interest rate. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer to the quiz question is the formula. Future value equals principal times 1 plus interest rate raised to the power of the number of years. This formula calculates the future value of the loan, including compound interest. When calculating interest on a loan to family, using an inflation calculator can provide a more realistic assessment of the loan's current value. Choosing an interest rate that feels fair and reasonable is essential, considering the context. Additionally, you might want to round down to keep the calculation simple and outcomes manageable. In summary, the key aspects of calculating interest on a loan to family include understanding the basic formula of principal times 1 plus interest rate to the power of years. Alternatives to cash interest such as dinners can maintain bonds. Practical tips include using inflation calculators, selecting fair rates, and simplifying. Always balance financial fairness with family harmony. Let's take a look at 3 examples of interest calculations. The first example involves a $500 loan at a 4% interest rate over 9 years, resulting in a future value of $717.44. The second example is a $1,000 loan at 3% over 5 years, totaling $1,159.27. Lastly, a $750 loan at 5% over 7 years equals $1,054.80. Thank you for tuning in to our video. If you found the content helpful, please like, share, and subscribe. We would love to hear your thoughts, so feel free to leave a comment below.